This one BIS decision could 10x silver overnight. Somewhere in a quiet office in Basel, Switzerland, a handful of regulators are reviewing a document that could rewrite the global monetary system. No press conference, no headlines, no warning, just a quiet reclassification of an asset most investors have already forgotten about. But if this decision goes the way insiders now believe it will, the price of silver will not simply rise, it will detonate. And by the time the public understands what happened, it will already be too late to buy in at today's price. Welcome back to Precious Metals Intelligence, the channel dedicated to decoding the strategic economic decisions that shape the future of money long before mainstream media catches on. If stories like this matter to you, the quiet moves made in institutions most people never think about, consider joining this community by subscribing. This channel is built for people who prefer to understand the world a little earlier than everyone else. And before we continue, we'd love to know where in the world you're watching from today. Drop your city or country in the comments below. This audience spans the globe, and it's always remarkable to see just how far these ideas travel. Most people have never heard of the Bank for International Settlements. It does not appear in daily news. It does not hold press conferences that trend online. It has no public face that ordinary citizens would recognize. And yet, this quiet institution in Basel, Switzerland, holds a kind of power that few organizations on Earth can claim. It is often called the central bank for central banks. When the world's biggest financial institutions need rules, standards, or guidance on how to manage risk, they look to this body for direction. One of the most important things this institution does is decide how different assets are classified. This sounds technical, and it is. But the consequences are not technical at all. They are enormous. When a bank holds an asset, regulators require that asset to be sorted into a category based on how safe and how liquid it is considered to be. The safest, most trusted assets are placed into what is known as Tier 1. Once something earns this status, banks are permitted to hold it as high-quality collateral, the same way they would hold cash or government bonds. For decades, gold sat outside this privileged category. It was treated with caution, discounted in value, and viewed by many major banks as a secondary holding. Then, in 2021, that changed. Global banking regulators moved gold into the Tier 1 category. Overnight, in a technical sense, gold became as trustworthy on a bank's balance sheet as cash itself. Few people outside the financial world noticed this happening at the time. There was no dramatic announcement, no headline that captured public attention. It was simply a quiet rule change, buried in regulatory language. But the effects were not quiet at all. In the years that followed, central banks around the world began buying gold in record amounts. Reserve managers who had spent years avoiding the metal began adding it back into national reserves. Demand grew steadily, year after year, and gold's price responded. What began as an obscure regulatory decision turned into one of the most important developments in the entire precious metals market. And by 2026, the price of gold had climbed to levels that would have seemed unimaginable just a few years earlier. Now, according to several respected voices in the world of macroeconomics, a similar story may be forming, this time around silver. Nomi Prince, an economist who has advised institutions including the World Bank, the Federal Reserve, and the International Monetary Fund, has publicly stated that she expects the Bank for International Settlements to eventually extend Tier 1 status to silver as well. She has not claimed this will happen immediately. She has been careful to say it may take another year or longer before such a rule is formally introduced. But she believes the direction is clear and that the foundation for this shift is already being built. It is worth pausing here to be fair and balanced. This is, at this stage, a prediction. It has not yet been confirmed by the Bank for International Settlements itself. No official announcement has been made. Analysts disagree on the timing, and some remain skeptical that silver will receive the same treatment as gold at all, given the very different roles the two metals play in the global economy. A responsible view of this story must hold two things at once. The possibility is real, and it is not yet guaranteed. Still, the reasoning behind the prediction is not without merit. Silver, like gold, has served as money for thousands of years across many different civilizations. It shares many of gold's core qualities: scarcity, durability, and a long history as a store of value. If it is true that the same regulatory body that transformed gold's status is now considering a similar shift for silver, then the implications could be significant, not just for large institutions, but for anyone paying close attention to where global finance may be heading next. The question then becomes uncomfortable but important. If a quiet rule change in 2021 was enough to help redefine gold's role in the modern financial system, what might happen if the far smaller, far more scarce market for silver receives that same institutional recognition? That is the question this story will now begin to answer, starting with a simple but often overlooked fact. The global silver market may be far too small for what could be coming its way. Picture two swimming pools. One is the size of an Olympic stadium pool. The other is barely large enough for a child to splash around in. Now imagine that a massive wave of new water suddenly needs to be poured into both. The large pool absorbs it with ease. The small one overflows almost immediately. This simple comparison helps explain one of the most important and most overlooked facts about the silver market today. The global gold market is enormous. Trillions of dollars worth of gold sit in vaults, reserves, and private holdings around the world. It is deep, liquid, and able to absorb massive buying pressure from central banks without dramatic price swings in the short term. Silver is a completely different story. The total value of all the investable silver in the world is a small fraction of the gold market. Some analysts estimate it at less than 1/10 the size. This is not a minor detail. It is the foundation of everything that could happen next. Silver is also unusual because it lives a double life. Gold is almost purely a monetary and wealth preservation asset. People buy it, store it, and rarely use it for anything else. Silver, on the other hand, is both a monetary metal and a critical industrial material. It is used in solar panels, electronics, medical equipment, electric vehicles, and military technology. In fact, industrial demand for silver has grown so quickly in recent years that it now consumes a significant share of total global supply, year after year, without pause. This creates a quiet but serious problem. Every ounce of silver used in a solar panel or circuit board is an ounce that leaves the market permanently. It does not return to a vault. It does not get resold as an investment years later. It is consumed and it is gone. This means that while gold above ground continues to accumulate and grow over time, silver above ground is being steadily drained by industries that have no interest in giving it back. Now add a second layer to this problem. For years, reports have circulated, some from insiders with direct knowledge of institutional trading, suggesting that a number of central banks, particularly in the Gulf region, have quietly been buying physical silver and choosing to take delivery rather than simply holding paper contracts. This is a meaningful detail. Taking physical delivery, rather than trading silver on paper, suggests a buyer who intends to hold the metal for the long term, not someone looking for a short-term profit. There's also something else worth noting. On more than one occasion in recent years, major exchanges have temporarily paused or restricted the ability of investors to take physical delivery of silver during periods of unusually high demand. These pauses were brief, and exchanges offered technical explanations at the time. But to careful observers, these episodes raised a simple question. If the physical silver market is truly as large and well supplied as it appears on paper, why would access to physical delivery ever need to be restricted at all? This is where the size of the market becomes so important to understand. If the Bank for International Settlements does move forward with a decision to classify silver as a Tier 1 asset, it would not be introducing new demand into a large, well-supplied market. It would be introducing potentially significant new demand into a market that is already small, already strained by industrial consumption, and already showing signs of tightness during ordinary periods of high demand. This is the core of what analysts mean when they describe the risk of a supply squeeze. It occurs when buying interest grows faster than available supply can comfortably absorb. In markets of this kind, price does not always move in a slow, steady line upward. It can move in sudden, sharp bursts as buyers compete for a limited and shrinking pool of available material. None of this guarantees a particular outcome. Markets are complex, and predictions are not certainties. But understanding the basic mechanics, a small market, a growing industrial demand, a history of physical tightness, and now the possibility of new institutional buyers entering the picture, helps explain why so many experienced observers are turning their attention towards silver right now. The next part of this story will examine exactly who these buyers appear to be, and why their pattern of behavior may be the clearest signal of all. There's an old saying among experienced investors: watch what people do, not what they say. Announcements can be misleading. Public statements can be designed to calm markets or shape opinion. But actual buying behavior, especially by large, sophisticated institutions, tends to reveal something closer to the truth. And when it comes to silver, the buying behavior of certain institutions over the past several years has been unusual enough to catch the attention of people who spend their careers studying global capital flows. According to individuals who have worked closely with central bank clients, particularly in the Gulf region of the Middle East, a pattern began to emerge some time ago. Several of these institutions were reported to be purchasing physical silver, not through ordinary investment channels, but by taking direct delivery through commodity exchanges. This detail matters more than it might first appear. Most participants in commodity markets trade paper contracts. They buy and sell promises tied to the price of silver without ever touching or storing the actual metal. Taking physical delivery is a different kind of decision entirely. It requires arranging storage, transportation, and long-term custody. It is not something an institution does casually, and it is rarely done for short-term speculation. When a central bank, or an institution connected to one, chooses physical delivery over paper contracts, it typically signals one thing: an intention to hold the asset for the long term as a strategic reserve rather than a trading position. This is precisely the kind of behavior that historically precedes major shifts in how an asset is treated by the broader financial system. There is more supporting detail worth examining. On at least 2 separate occasions in recent memory, major commodity exchanges quietly restricted or paused the ability of market participants to take physical delivery of silver. These interruptions occurred during periods of exceptionally high demand, and exchange operators offered various technical or procedural explanations at the time. Yet, for analysts who track physical commodity flows closely, these pauses raised a deeper question. Exchanges do not typically need to intervene in markets that have abundant, easily accessible physical supply. The fact that intervention occurred at all suggests that the underlying physical market may be considerably tighter than public price charts would lead most observers to believe. To understand why institutions might be drawn towards silver specifically, it helps to look back through history. Long before modern paper currencies existed, silver served as a primary form of money across many of the world's most significant civilizations. Entire national currencies still carry silver's legacy in their names today. The British pound is tied to the word sterling, historically a reference to silver coinage. The Spanish dollar, which later influenced the American dollar, traces its origins to a European silver coin minted centuries ago. Even in parts of Asia, the traditional word for banking institutions has historical roots connected to silver. This is not simply an interesting historical footnote. It reflects something deeper about how human societies have repeatedly turned to silver during times when trust in paper money began to break down. This historical pattern becomes especially relevant today, as many national currencies face mounting pressure from rising government debt and years of aggressive monetary expansion. When confidence in paper currency weakens, history shows that institutions and individuals alike tend to return to assets with a long proven track record of holding value. Gold has traditionally led this shift, but silver, given its own deep monetary history, has often followed closely behind, particularly once its price becomes attractive enough to justify large-scale accumulation. None of this proves with certainty what any specific institution's future plans may be. Central banks do not publish detailed announcements explaining their reserve strategies in advance, and much of what is known comes from indirect reporting, informed observation, and patterns that experienced market participants have pieced together over time. Responsible analysis requires acknowledging these limits. However, when several distinct signals point in the same direction, quiet accumulation, a clear preference for physical delivery, unexplained restrictions on physical access during high demand, and a currency history that keeps circling back to silver, it becomes difficult to dismiss the pattern entirely as coincidence. Institutions with access to teams of professional economists and years of market data do not typically make significant long-term purchasing decisions without a strategic reason behind them. This raises the central question this story now turns to. If large, patient buyers have already been positioning themselves quietly for years, what happens if a formal regulatory decision arrives that validates their strategy publicly and invites the rest of the banking world to follow their lead? That is the domino effect this story will examine next. To understand what a formal Tier 1 reclassification would actually change, it helps to think about how banks are required to operate. Banks do not simply hold whatever assets they wish. They operate under strict rules that determine what counts as safe, reliable collateral. Assets placed in the Tier 1 category are treated as being nearly as dependable as cash itself. This status affects how much of an asset a bank is encouraged to hold, how it is valued on official balance sheets, and how comfortable large institutional investors feel about accumulating it in size. If silver were to receive this classification, the immediate effect would not be visible to most ordinary people. There would likely be no dramatic headline, no viral news story. Instead, the shift would occur quietly inside the risk models and allocation strategies of major banks and reserve managers. Silver would transition, on paper, from being viewed as a secondary commodity to being treated as a recognized, high-quality strategic reserve asset. And once that happens, banks that had never considered holding meaningful silver reserves would suddenly have a clear regulatory incentive to do so. This is precisely what occurred with gold after its own reclassification in 2021. At the time, the announcement received relatively little public attention. Yet, in the years that followed, central bank gold purchases climbed to some of the highest levels recorded in decades. Reserve managers who had spent years holding minimal gold began steadily increasing their positions. This shift in institutional behavior became one of the primary forces behind gold's remarkable price performance in the years since. Now consider the same scenario applied to silver, a market that, as previously discussed, is only a small fraction of the size of the gold market. If even a modest percentage of global reserve managers began treating silver the way they currently treat gold, the demand created would be entering a market with far less available supply to absorb it. In markets defined by scarcity, even modest new demand can produce outsized price movements. This is the basic mechanic behind the dramatic price scenarios some analysts, including Nomi Prince, have discussed publicly, with price targets that would have seemed extreme just a few years ago. At this point, fairness requires an honest pause. Regulatory change of this kind does not happen quickly, and it certainly does not happen with certainty. The Bank for International Settlements has not made any official announcement confirming that silver will receive Tier 1 status. Analysts who follow this institution closely note that its decision-making process is slow, deliberate, and often takes years to unfold. Some experts remain doubtful that silver will ever be treated identically to gold, given the important differences in how the two metals are used across global industry. A careful, professional analysis must hold space for this uncertainty, rather than presenting the outcome as guaranteed. Yet the broader pattern remains difficult to dismiss entirely. Quiet institutional accumulation, a clear preference among certain buyers for physical delivery, unexplained restrictions on that delivery during periods of high demand, and now public commentary from respected economists suggesting further regulatory support for silver may be approaching. Together, these signals describe a market that appears to be positioning itself well ahead of any formal announcement. Historically, this is often how major shifts unfold. The institutions with access to detailed information rarely wait for public confirmation before acting. By the time an official decision is announced, much of the smart positioning has often already taken place. This leads to the question every serious observer must eventually confront. If this pattern continues to develop, as it has, quietly, steadily, and largely out of public view, what should business professionals, investors, and everyday individuals understand about their own position today? That is where this story turns next, in its final and most important part.